Happy Tuesday, everybody. I hope you had a great long weekend. As it seems to be the norm recently, last week was a busy week. Let's review what happened and then preview this coming week. A few quick facts about the market leadership as the week started. 5 stocks accounted for 7% of the 9% year-to-date move in the S&P as the week started. Yes, that's the quick math. 1% of companies, 80% of the gains. Of course, we know the stocks: Apple, Microsoft, Nvidia, Meta, and Amazon. We do need more leadership to take the market significantly higher, but of course, recall what happened with the FANG stocks, what they did in the late 2010s. They led the market year after year. It is something you hear from me a lot, but this is the time to review your holdings to see if you need to adjust your allocations. Remember, risk is still a 4-letter word. Let's see what happened last week. Monday saw stocks open higher, even as news that China reignited the trade war and banning Micron chips for national security issues. I'm not sure why anyone was surprised by this. We did the same thing the other way, but the market seems to see it the other way, or at least the market realized the potential loss of revenue on the Micron side. Bigger usually here is really trade tensions. It's important that we keep that tamped down. In case you're wondering how big our trade with China is, 2022 numbers, according to the Census Bureau, exports were $150 billion, imports over $535 billion. We should probably learn how to play nice. We did get a first-hand account of how fake news, really fake news, can affect the markets in the short term. Literally, a picture that was AI generated to show an explosion outside the Pentagon went viral, and for about 3 minutes, long market minutes, there were about $100 billion in short-term market losses as the market sold off on this news. Just a blip, discredited, and then back to normal, picked up the market value also, but you have to notice that. We did get Fed speak from Bullard, who was one of those outliers testing the waters. Who don't know, he is not a voting member of the Fed, but he was very hawkish, talked about 2 more rate hikes. We are not hearing a lot of this, so let's see how the narrative plays out. By the end of the day, the Dow was down 1/3 of 1%, S&P was virtually flat, and the NASDAQ was up 1/2 of 1%. Stocks opened slightly in the red on Tuesday as the eyes were still focused on the shiniest object in the room, the debt ceiling negotiations. I've told you my bull case and the LPL, that of LPL and many others, is that this does get done, but not without necessary grandstanding. Over the weekend, of course, a lot of this changed, but this is still last week we're talking about. So, eco data was mixed from both the UK and the US, mostly in line with the idea of a potential soft landing, but interpretations differed daily. Headlines out of Washington were the wind in the sails all day long, and none were in the right direction. Fed Chair Powell showed up at the Capitol, and that seemed to spook markets. Speculation of meetings with House Dems and him. Overall, the risks were to the market were too much. Debt ceiling negotiations, regional banks, hard landing fears. Overall, the market gave back a lot of the gains recently picked up. The Dow was down about 2/3 of 1%. S&P down a bit over 1%, and the NASDAQ was down 1.25%. It could have been worse. Markets gapped lower on Wednesday on Chinese growth worries. Remember, they are one of the major players in the global recovery that we're counting on. Later in the day, the sour mood on Wall Street continued as the debt ceiling issue is still front and center. You know how I feel about this by now. Yellen spoke about the X day again, June 1st at the time, though talk is that the government can make it to June 15th when they'll get quarterly tax money again, and that may keep them going for a bit longer, so who knows. But as we know, we have a deal on paper, but the market did not know that last week. Fed head Waller tried to take the spotlight away from the debt ceiling and remind everyone that the Fed is the newsmaker, and he said that even if there is a pause in June, that doesn't mean that there will not be a resumption in July. Fed minutes were out from last month. There was something for everybody, so not much to move things. Open to a pause, we know that. May need more rate hikes, we know that. Still no guarantee about the pause in June, but looking more likely. For the day, all 3 major indices down about 3/4 of 1%. All the news was after the close. First, on the debt ceiling front, Fitch, most known as the third of the 3 major rating agencies, put the U.S. on a watch for negative downgrade. Recall the S&P downgraded the U.S. debt in 2011. Nothing from S&P or Moody's as of Wednesday afternoon. Then the big blowout earnings that honestly took all of the oxygen out of the room. Nvidia had an amazing quarter, and the maker of chips that AI will be using was up about 25% in the after hours. Overall, the indices, and then overall, the indices did open mixed on Thursday, but Nvidia made its presence known in the S&P and the NASDAQ, but up on the day. The Dow was down, but that was because Nvidia is not in the Dow. So the debt ceiling was virtually ignored for most of the morning while everyone lined up to talk about the Nvidia chip and the new version of the internet revolution. By later in the day, we did get whipsawed a little bit of debt ceiling news. It was moving things, not just Nvidia. The deal should be done by tomorrow was the first thing that moved things positive. Then White House is dusting busting off contingency plans that move things negative. And then finally, the optimism prevailed and the markets approached session highs as the techs were in charge of the show again. NVIDIA and Microsoft accounted for 80% of the S&P gain on the day. The Dow was down slightly on the day. S&P was up about 0.75%. The NASDAQ was up almost 1.75%. Friday saw stocks keep the party rolling on. Forget EcoData. Remember that pesky PCE that the Fed watches so closely? Well, that was hotter than expected, but that was lost. Markets are still pricing that there will be a rate hike in June. What pause? Consumer sentiment was also a bit higher than expected, but lower than last month. Again, ignored. Fed head Mester even tried to get a word in, still holding out for rate hikes. All of this and optimism on the debt ceiling deal, which of course looked like it was well-founded, was the flavor of the day. And NVIDIA, anything AI, they were still moving up. A lot of companies got in on the action, but still led by just a few names. The Dow was up from Intel and American Express moves, close to 1% for the day. S&P up 1.33%, and the NASDAQ up 2.25%. For the week, the Dow was still down 1%. S&P was up 1/3%. The NASDAQ up for the 5th straight week at 2.5%. This week, we're already off to the races and a short week to boot. Today started with news on the debt ceiling agreement. As I mentioned, and I'm sure you've heard about, there's still actions that need to be taken. Minor details like passing it through the House should be tomorrow, and then the Senate Friday or over the weekend. Then it gets the president's signature. Back to the Schoolhouse Rock thing. I'm just a bill. I don't think that described the horse trading that went on, but you get the picture. NVIDIA and AI are still front and center. It's hard to find anyone who will call this crazy move in stocks or even the idea of AI. This is the new revolution. Just ask anyone. As you know by now, I'm a bit skeptical of things like this. In the end, there must be profits and earnings. Some of the moves are valid, many may not be. This week we'll get Fed heads, Barkin, Collins, Bowman, Harker, and Jefferson. Do they have trading cards on these guys yet? We'll also get some pretty important eco data, housing info today, not really market moving. JOLTS survey tomorrow starts the labor market news, then the Beige Book, ADP report and jobless claims on Thursday. Watch for the unit labor costs, and most important of the week, the non-farm payrolls on Friday. We'll see if and when we'll get the focus back on the hard landing, soft landing debate, since the distraction of the possible defaults should be gone. We've got a smattering of earnings this week too. Retail comes in with Macy's and Nordstrom, Lululemon too, and a few others. The question for the week is, will artificial intelligence take all of the oxygen out of the room, or will they share? Will we broaden the move out a little bit? We are at the top of the recent range, 4,200 on the S&P. This is pretty rich on the valuation side, in my opinion, especially if the eco data is steady and shows the stickiness of inflation. We'll just have to see. For now, remember, we need to stay focused on the long-term goals. This will all flush out. Please keep engaged with the plan. We'll keep that as the main part of the conversation. Come back on Friday for another planning video. It's a lot to talk about. One more month until the end of Q2. Can you believe it? Have a great week.